Has assessed the tone for the week now is Karl Schamotta. Karl is the chief market strategist at Corpay. Always nice to see you, Karl. Let's start with the Bank of Canada. I guess that'll be one of the big watch points for the Canadian market this week. You expecting them to just hold the line on interest rates for now?
That's right. I don't think anyone on the street is expecting a hike or really any adjustment here. We are expecting a hold, but also a relatively hawkish bias in the accompanying statement. So, we do think that they're going to acknowledge the sort of downside risks that emanate from that recent banking turmoil in the U.S., but at the same time, they're going to point to, signs of resilience in the economy, an economy that's been growing more rapidly than their own projections suggested, as well as employment that is continuing to generate gains for income and for aggregate spending across Canada.
And so I guess people are trying to piece together what that means. We've kind of explored every possible scenario for the economic road ahead. I mentioned the possibility of a technical recession becoming a reality in Canada. What's your best guess on how the rest of the year plays out?
Right. So I think we're going to see sort of a brief burst of optimism here. And that might mainly come from the idea that the Fed has reached its sort of terminal rate and that rates aren't going to climb anymore. But beyond that, we do think that, at some point, gravity sort of reasserts itself and we start to see consumers in Canada dealing with that higher debt load, dealing with the huge increase in interest costs and in carrying costs. At some point that we would expect to see a contraction in overall spending. And that is very, very likely to drive the economy into negative territory, at least from a growth perspective. All that said, we don't want to sort of feed sort of the apocalyptic headlines out there. At this point, the strength in the Canadian economy is coming from the labor market. We are looking at a labor market that is historically tight. We're looking at relatively robust global demand. Those things should mean that, as the economy slows, that it doesn't, turn into sort of a precipitous slide like we've seen in the past.
And I'm trying to balance this reference that I made to the markets, thinking it's possible that the Bank of Canada may end up cutting rates by the end of the year. I would assume that's because of the worries on the economic front with this continued fight against inflation. And just to be clear here, even though, we've got a series of measures indicating an easing in inflation, when you talk about the jobs market being tight and you look at what's happening with wages, there is quite a challenge, it seems, whether it's for the Bank of Canada or arguably for a lot of central banks right now.
That's right. I don't know what markets are thinking, quite frankly. I do not know why we have two cuts priced in for the U.S. this year and a cut priced in for Canada. It just doesn't look all that likely on the numbers right now. At the end of the day, we're looking at a situation where, the core inflation measures that central banks attempt to target remain extraordinarily robust. If we were to see a shock in the employment market, it would take something absolutely spectacular to bring us, to a halt or to, push the Fed into an accommodative stance. And same here in Canada. So, our view at this point is that we will not see a rate cut from any major developed economy central bank this year, which, it's weird to be sort of an outlier on this, but, we just don't see those signs occurring. And I'm not saying that, we think that it's going to be sunshine and roses or anything like that, that the global economy is in great shape. It's not. But the reality here is that, inflation remains the bigger risk. Employment market tightness is a characteristic of virtually every major economy. We just don't see a good reason to push central banks back into an easing cycle and toward providing more accommodation in the face of inflationary risks.
Let's tie that back to what you watch, a lot of the market themes, certainly what's happening in the currency market. If the market is overestimating the likelihood, for example, of rate cuts in the U.S., you would think, oh, well, maybe that's a sign of strength for the U.S. dollar, which, of course, has been pretty strong the last couple of years. But you've seen a lot of other assets entering the mix. I mean, I guess for our exercise here, we'll call currencies assets. But, the fact that people are taking a closer look at gold these days. Give us your sort of best assessment of what's been happening in the currency market.
Right. So, coming into this year and even now, the overwhelming consensus has been that the dollar should weaken. Right. That the Fed will stop hiking and then start cutting more rapidly than other central banks. The only currency really that I can think of that at least among the majors that was similar to that was the Canadian dollar. There was this idea that the Bank of Canada would outpace the Fed in pivoting and then beginning to loosen. The question at this point is whether that's really true, right? So this assumption is that other major economies are going to remain relatively stable, that they'll start cutting much later than the Fed. And incoming data is telling us the opposite, right? The incoming data that we're seeing is telling us that the Fed is going to respond to a tight U.S. labor market, to an overheating economy by staying on hold for a prolonged period of time to keep rates higher for longer in the parlance. And that suggests to me that you're looking at a dollar that retains its value for longer than markets currently expect. And so if that's the case, that is relatively bearish for other currencies, perhaps less bearish for the Canadian dollar, but certainly for the euro and the pound. So, what we could see here is the emergence of sort of a short squeeze in global currency markets in the months ahead as that positioning sort of is forced to pivot really dramatically.
Now, just before I let you go, we obviously are sensitive to higher interest rates in this country, as evidenced in household debt levels because of the mortgage market. At what point do we have to have a deeper conversation around whether we're going to see real deterioration tied directly to that particular issue? How closely will you be watching that?
I don't think I'm watching anything more closely. At the end of the day, it's shocking that the Canadian economy has not slowed more dramatically than it has. That that employment is as robust as it is. It really seems to me that the lagging impact of last year's tightening cycle should be hitting home. That consumers should be shifting spending patterns, but we're just not seeing it yet. I think it's coming in the coming months, but we're not seeing it in the data yet. And the Bank of Canada is unfortunately, to a very large degree, sort of pinned between a rock and a hard place at this point. They can't respond to the data by cutting rates, but at the same time, they can't continue hiking because they are aware that there's huge downside risk ahead for the Canadian economy.
All right, great.